Two investors each have $12,000 to put into the same stock on the same day. One invests everything immediately. The other spreads it across 12 monthly installments of $1,000. A year later, one of them has 57% more shares than the other, and it's not always the same person who wins. Dollar cost averaging, DCA, is just one rule applied mechanically. Invest a fixed dollar amount at regular intervals, no matter what the price is doing. That fixed dollar amount does something automatic and elegant. When the price is high, your $1,000 buys fewer shares. When the price is low, that same $1,000 buys more. No forecasting, no judgment call, no watching charts. The mechanism is pure arithmetic. Shares acquired equals dollars invested divided by the current price. Price drops, denominator shrinks, shares go up. It's involuntary bargain hunting built into the structure of the plan. Walk through the actual numbers with our investor's $12,000. Month 1, the stock costs $50, so her $1,000 buys exactly 20 shares. By month 6, the stock has fallen to $25. That same $1,000 now buys 40 shares, double the haul. By month 12, the price has recovered to $40, so she picks up 25 shares. Notice what's happening across those 12 months. Her share count moves in the opposite direction of the price every single time, without her doing anything. The months with the worst headlines are the months she's buying the most. That inversion is the entire engine of DCA's advantage in a falling market. Now for the mathematical surprise underneath the surface. When you invest equal dollar amounts at different prices, the average cost per share you end up with is not the simple average of those prices. It's something lower. To see why, try 2 periods. Price $100, then price $50. The arithmetic average of those two prices is $75. But invest $1,000 at $100. You get 10 shares. Invest $1,000 at $50. You get 20 shares. Total, $2,000 spent, 30 shares owned. Divide. $2,000, 30 into 66.67 per share. That's $8.33 cheaper than the $75 arithmetic average, and you didn't pick a single price. The math did it for you. This property has a name, the harmonic mean, and the harmonic mean of any set of varying positive numbers is always less than or equal to their arithmetic mean. So DCA is always mathematically cheaper than the simple average of the prices you paid, but cheaper than what? The question that matters is whether DCA is cheaper than lump sum, and the answer depends entirely on which direction the market moves. In a falling market, the comparison isn't even close. If you put $12,000 into a stock at $100 on day 1, you own exactly 120 shares, full stop. The market then falls linearly to $40 over 12 months. Every single dollar of your capital was committed at the worst price of the entire period. The DCA investor, spreading $1,000 a month across that same decline, averages a cost around $64 per share and ends up with roughly 188 shares. At any recovery price above zero, she holds 57% more shares. The lump sum investor bought the whole position at the top. But flip the scenario. The market is rising steadily from $40 up to $100 over 12 months. Now the lump sum investor puts in all $12,000 at $40 and owns 300 shares. The DCA investor's first $1,000 buys 25 shares at $40, but each subsequent installment buys at a higher price. By the time she deploys her last $1,000 at near $100, she's buying fewer than 11 shares with it. Add it all up, she ends up with about 171 shares at an average cost around $70 per share. At the final price of $100, lump sum portfolio is worth $30,000. DCA portfolio is worth roughly $1,100. That $12,900 gap isn't bad luck. It's the mathematical cost of deploying capital late into a rising market. Every dollar held in cash while the asset appreciated was a dollar not compounding at the asset's return rate. So we have a genuine dilemma. DCA wins in falling markets. Lump sum wins in rising markets. To know which strategy is better overall, you need to know which type of market is more common. And this is where a landmark Vanguard study from 2012 delivers the uncomfortable answer. Researchers tested rolling 12-month periods across 3 major markets, the US, UK, and Australia, from 1926 to 2011. They asked, in how many of those periods did lump sum end with a higher final value than 12-month DCA? In the US, lump sum won 68% of the time. In the UK, 71%. In Australia, 63%. Average that out and lump sum beats DCA in roughly 2 out of every 3 periods across 85 years of real market history. Markets rise more than they fall, and that single fact tilts the mathematical scoreboard heavily against DCA. The 3 markets aren't identical, but they all tell the same story. The US saw lump sum win 68% of periods. The UK pushed that to 71%. Australia was the closest contest at 63%, but lump sum still won. And the margin wasn't just a statistical sliver. The median outperformance of lump sum over DCA was about 2.3 percentage points of final portfolio value. That's meaningful, but it's also a bounded number. 2.3 percentage points one time on a single deployment decision. Hold that figure in mind, because it becomes the crux of everything that follows. Here's where the logic takes a sharp turn. The Vanguard finding tells us what the math prefers, but the math assumes an investor who puts in the lump sum calmly and then holds, never panicking during a 30% drawdown, never selling at the bottom, never hesitating at all. Real investors don't behave that way. Dalbar, a financial research firm, has tracked actual mutual fund investor returns for over 2 decades. Their consistent finding: the average equity fund investor earns roughly 2 to 3 percentage points less per year than the index they're invested in. Not once, not over one deployment decision. Every single year, compounding. The culprit is behavioral. Buying after markets run up, panic selling in drawdowns, then waiting too long to get back in. That cycle of mistiming is what costs 2.5 percentage points annually. Now put those 2 numbers side by side and the picture shifts dramatically. DCA's mathematical cost versus lump sum is 2.3 percentage points, one time on one deployment. Behavioral mistiming costs 2.5 percentage points per year, every year, for as long as the investor is in the market. A 30-year investor who avoids behavioral drag saves roughly 75 percentage points of cumulative drag versus one who succumbs to it. The one-time cost of DCA's mathematical inferiority is essentially noise against that scale. DCA doesn't win on the math. It wins by taking the emotionally explosive decision of when to invest completely off the table. You can't panic buy or panic sell a monthly auto investment. So the real question isn't which is mathematically superior in the abstract. It's which strategy produces better outcomes for this specific investor in this specific situation. And when you frame it that way, a clear decision map emerges. Ask yourself 3 questions. First, do you actually have the full lump sum available right now, or does your capital arrive periodically as salary? Second, will you hold without flinching through a 30 or 40% drawdown in the year after deploying everything at once? Third, is the market environment clearly trending in one direction? Your answers route you to a strategy, not a universal rule, but the right tool for your actual position. Consider 2 concrete scenarios that illustrate the boundary exactly. Scenario A, an investor receives a $500,000 inheritance. She's financially experienced, emotionally detached from short-term volatility, and the market shows no confirmed downtrend. The Vanguard data says lump sum outperforms in 68% of historically similar situations. The mathematical case for deploying immediately is strong, and behavioral risk is low for this investor specifically. Scenario B, a salaried worker sets aside $3,000 a month. For him, DCA isn't a strategy choice, it's a description of reality. The capital simply doesn't exist until it's earned, and yet he still captures the harmonic mean advantage automatically every single month, without ever consciously choosing it. His salary schedule enforces the discipline the math rewards. There's one final layer worth understanding: the asymmetry of regret. A lump sum investor who deploys $500,000 and immediately watches the market drop 30% faces a paper loss of $150,000, all at once on day one. Even if they hold and recover, the psychological experience of that moment is brutal, and research consistently shows that people weight losses roughly twice as heavily as equivalent gains. A DCA investor who sees the same decline watches their installments buy in cheaper and cheaper. Their paper losses at any given moment are smaller in absolute terms, and each new purchase feels like an opportunity rather than a compounding disaster. The behaviorally informed case for DCA isn't about being irrational. It's about designing a system that keeps you in the market through the discomfort, because staying in is where the returns actually come from. Pull all the threads together, and the picture is genuinely nuanced. Not a winner and a loser, but 2 tools with distinct jobs. DCA's mathematical edge is real in falling markets, powered by the harmonic mean. Equal dollars automatically buy more at lower prices, producing a cost per share that no amount of forecasting could reliably beat. Lump sum's mathematical edge is real in rising markets, and since markets rise more than they fall, lump sum wins on pure math roughly 2/3 of the time, with a median advantage of 2.3 percentage points. But human behavior erodes far more than 2.3 points per year in chronic mistiming losses. So DCA's true value isn't outperforming the math, it's outperforming the behavior. The investor who automates monthly contributions and never touches the plan in panic isn't leaving 2.3 points on the table. She's saving the 2.5 points per year she'd lose by trying to time her way to a better entry.